Now, the global banking sector has become one of the most heavily regulated entities across the economies following the 2018 global financial crisis. However, or 2008 rather. Now, the banking financial institutions have operated under a much less stringent conditions. They just concluded World Economic Forum for 2024, devoted a panel of experts to discuss the implications of the light touch regulations to global financial stability. Let's take some excerpts.
Are we in better shape than 15 years ago?
Yeah.
Absolutely. If you look at the leverage in the system 15 years ago, was just a multiple, and you can measure it through really the leverage of banks. And you could see how the return on equity in the banks was so elevated because of the leverage. In terms of the environment or the market getting bigger, well, that's a function of the world growth of the economy. Mm-hmm. There's a demand for this credit. So if the economy wasn't growing, actually, if it were the same size, that would be pretty scary, because the economy would suggest that the world economies are not growing. So I feel like we're in much better shape. That's not to say you take something like the pandemic and you see something like mortgage REITs, which had margin leverage, which seemed like a smart idea at the time until it wasn't. And they basically all had margin calls. So there was a run on that sector of finance during the pandemic. But broadly speaking, the system is much better. I think, and you continue as some of the episodes of last year with Silicon Valley Bank, Credit Suisse, there certainly are refinements, but broadly speaking, much better.
May I pick up on that?
Yes.
Because if you looked at the share of non-bank financial institutions, according to the FSB, in financial assets, it was 47% in 2007. Today, it's 47%. So apropos of your comment, the world just got bigger. Now, it's a big problem because it's a lot of numbers, but the world is safer in the sense because their banks now hold more capital, so they have less leverage, they're more regulated from a liquidity point of view. The fact that we have, and by we I include a pension fund as one of the shadow banks, have occupied some of that territory. We do not engage in maturity transformation. We do track our liquidity, and we have far less leverage than a bank, which would be 24 to 25 to 1. Inherently, the world is a safer place. That's an intended consequence, I think, of the capital regulations imposed on banks, that activity went into the so-called shadow banking sector.
With the evolution of the fintech over the last 10, 15 years, I think we should be expecting significantly different products and different choices, different risk, different investors base, and different borrowers base or beneficiaries base as a result of that. But obviously it is all also about credit. I mean, it's at the end of the day, it's just being able to provide credit faster, cheaper, and with more choice.
If I could add on to the comments of His Excellency with regard to, there's a couple of other things too, and that is the synthetically created securities, CDO squared and the like. They failed in the late 1990s. And there were short memories because then they became reinvigorated and became a big part of the leading edge of the problem when the financial crisis occurred. And if we're kind of thinking about the one word that is probably the most important for regulators and investors to be thinking about, and that is the extreme levels of leverage that can be created, and an extremely risky area would be synthetically. Mm-hmm. And so as long as we don't see that and the rise of that, and I hope our memories aren't terribly short with regard to the impact of those types of transactions.
And I actually want to stay with you for a second, because His Excellency did mention that, with fintech, there's been a variety of growth of types of instruments. But the question I want to ask you, so Jamie Dimon, unfortunately, could not be here. So I'm going to pretend to be Jamie Dimon. And if I'm Jamie Dimon, I'm going to say the only reason this private market grows is because we as banks, we have capital requirements, which are bigger than ever, more stricter than ever. We have liquidity requirements, which are more onerous than ever. My risk controls are being checked all the time. I am held to disclosure requirements and so forth. And plus, I get called before Congress every 6 months and get, the stuffing beaten out of me, right?
Yeah.
That's why your market has grown, because it's an arbitrage play. You don't bear any of those costs. What's the answer to that?
Well, with all due respect to Jamie Dimon, I think it's a little bit more fundamental than that. And that is the capital markets, particularly as I think about the U.S., have changed dramatically over the last number of years. We've gone from a world where there were many, many publicly listed companies in the U.S. We're down to about 3,600 listed stocks in the U.S. And contrast that with private equity-owned companies.